Yeah, I mean, first of all, I heard all the comments all the other guests made, and I agree. This is a pretty treacherous period for markets. But I'm still going to lean into this weakness. And the reason we think it makes sense to is, one, I think the jobs report is validating that the underlying economy still remains pretty strong. And with the move in rates, and while that's alarming, we still have negative real interest rates. And then we know investors have essentially panicked because they raised a lot of cash in the first 8 weeks of this year. And on top of that, sentiment has collapsed. And I think, a seismic hit like Facebook even added to that misery. So the cues I'm sort of looking at, and the reason we're staying bullish is, the VIX term structure is actually normalizing, which means it's a risk-on signal. And I'm kind of encouraged by the rally in oil because that is a sign of underlying health of the economy. And I think on a risk-on, one of the cues that we should be focusing on is the fact that Bitcoin's back above 40,000. So we're still going to tilt towards February is going to end up being a rally month, but clearly the last couple of days have been, horrifying.
What happens if the 10-year goes over 2%, Tom Lee? Is the market able to have a violent rally in the face of a 2% 10-year? Now we are, 30-some-odd% predicting a 50 basis point move, or at least another hike. I can't remember where we are, at least at this point. But the fact of the matter is the market's expecting a more aggressive Fed this morning than it was yesterday. 2% 10-year doesn't throw you off?
I mean, it is about perspective because, for someone who started to track rates, in 2020 at 50 basis points for the 10-year, it's obviously alarming. But, in 2019, the 10-year was over 2%, and it was nearly 3%, or actually almost 3.5% in 2018. So I think a 2% 10-year and its CPI is 3, we still have negative real rates. That really generates excess returns for risk assets, for assets deployed for real estate. So I view it as a risk-on signal still.